Hello and welcome to the NC podcast. My name's Natasha Collins and I am the host and founder of NC Real Estate, which includes its members club for landlords and property investors to come and build profitable property portfolios that completely aligns with their goals. This week, I am so excited for my guest, Josh Hayseldon, who is from the Mortgage Advice Bureau, and I'm very excited for two reasons. Number one, Josh just got me a remortgage, which is going through at the time of recording tomorrow. So I'll get some cash out of a property for, if you remember in last week's podcast, I was talking about a property that I found. So that money will go into that property. And also because, Josh, we have to talk about mortgages and lending and what's going on. So hello, thank you for coming into the podcast and being with me today.
Hello. Yes, hi. Are you okay?
Good, thanks. How are you?
I'm good, thank you. I'm great, as always.
Good. I'm glad to hear it. So, you are a mortgage broker.
I am. So I'm a mortgage advisor for the Mortgage Advice Bureau. Predominantly, do a lot of buy-to-let, do a lot of remortgages, a lot of purchases. Got a couple of, portfolio landlords that I deal with on a regular basis. Also do a lot of residential stuff. So I manage I work for a couple of local estate agents, have a few various ones around the country as well. So I do a bit of telephone advice and face-to-face. So yeah, a bit of a jack of all trades when it comes to mortgages, I'd say. So you've
seen quite a lot of what's going on recently, and I guess the first question then, and these questions have come from my audience as well as things that I get asked all of the time. So first question, Are mortgages easy to get right now? Yes,
definitely. In my opinion, it's the best time to get one as well. If you are sort of looking, and so we say that this is the best time. Rates are absolutely fantastic. Lenders are getting more flexible by the day. They're all trying to compete with each other. So the only way for them to compete with each other is for them to be more flexible. Mm-hmm. So you've got a lot of lenders now that, are looking at all kinds of things. So for buy-to-let, they're going away from the traditional 25% deposit, and you can now get sort of, 80%, 85% loan to value. In terms of applicant profile, looking at credit impairments, there are plenty of lenders out there now that you can get with sort of impaired credit history. Mm-hmm. So I would definitely say that they are based on, certainly from a year ago, in the last 12 months, definitely. It just seems to be getting easier as time goes on. And I think, I think it will only continue to get better as well at the moment from what I'm experiencing.
And is that just because of uncertainty in the market? There's less people buying, so there's less people lending. So lenders are just like, please, I want to give you money.
I think there is an element of that. I think, definitely in the residential side of things, yes, there is a lot of sort of hesitation. I would say it's not as much on the purchase side. I'd say it's more on the putting kind of sale side. So I think people are more hesitant to put the house on the market now. Mm-hmm. I think if there are people out there that are thinking of moving, maybe just putting that off for sort of 4 or 5 months at the moment, just to see what happens, obviously in the economy over the next couple of months. Mm-hmm. I think the lenders, I think that they have to become more flexible. I think we're in a day now where certain things are becoming a lot more common. And technology is helping as well. Technology is helping massively. Obviously, you've got your credit scores, your open banking, all the things like that, all the systems. It's all playing its part. And the FCA is having a big drive on sort of execution only at the moment as well. So I think it's all changing, but I think it's going in the right direction.
Okay, and so one of the big things that I know that stops property investors from being able to get these higher loans is the stress tests that we all have to jump through. Can you explain what the stress tests are and how you know how much to borrow? Because I'm always asked this, and people turn around, they say to me, Natasha, I've been out for £500,000 worth of borrowing and the bank has said no. Can you tell us why?
Yeah, so stress testing is one of those. Yeah, it's one of those things, and it is one of the biggest obstacles. Personally, for me, yeah, when it comes to buy-to-let lending, it is a really big obstacle, and it can be for residential as well in terms of affordability calculations. You know, people will say, "Oh, well, I can clearly afford this. Why can't I borrow it?" And it's because, you know, although the rates, you know, you might get a rate of 2.2%, the lender will actually be probably testing the payment against the rate of 5.5. So that is a common stress test rate at the moment. So you're seeing a lot of the big players using the standard sort of 5.5% interest, the ICR at 140%, which is interest coverage ratio. So that's how it works. So what they're wanting to do is they're effectively testing that rental income against a much higher mortgage payment as opposed to what it is at the moment. So yes, a mortgage advisor or a bank will give you a quote, and the rent will probably exceed it and give you plenty of profit. However, what the lender is doing in the background is they're testing that rental income at a much higher interest rate. Now, some lenders don't necessarily have a cap. You know, some lenders can test it at all sorts. You know, we've had it at 9%, all sorts before. So it's that's where the difficulty come in. So you do have lenders that are stricter than others. So you will find, I mean, like the quotes I've given you recently, you'll have some lenders that will give you so much, and then you might get another lender, the exact same interest rate, but they're willing to give you potentially 10 or 20 more thousand just because their stress test calculation is a bit more friendly to the applicant. And it is just, you know, it's not going to go anywhere. It's there for the, you know, the applicant's protection just as much as it is the bank's. So it, you know, it is just one of those things. But that's how it works, and that's kind of how it's calculated. All the rates, you know, the stress rates are different. You do have potentially in some situations where it can't be done. So I know some lenders, you know, if you hit a certain income threshold, some lenders won't stress test an application.
Okay.
So I would say if you are in that kind of situation, that it's always best to get that advice from someone like myself, because what we can do is we can check all the lenders rather than sort of you having to go around and ask them all. We can, you know, we know where to go when we get a certain situation. So if I get a rental income and I know straight away it seems a little low for the loan amount, I'll know which lenders will be more generous, and I can sort of go to them in the first instance.
Okay, interesting. There was something else that you've said to me recently, which I wanted to pick your brains at, is
yes,
why can you have lower rental income with longer term mortgage products?
So that's known as the ICR. So that's the interest coverage ratio.
Okay.
So what they're doing is they're just making the stress test a bit more flexible, or they may not be stress testing it at all. So, for example, if I'm doing a residential mortgage for someone with a 2-year fixed, or I'm doing a 5-year fixed, as an advisor, I don't have to discuss stress testing if we do a 5-year fixed, whereas I do if we do a 2-year. And the main reason for that is just the amount of stability a 5-year fixed gives compared to a 2-year fixed. So lenders just kind of take, you know, a stance on it, and they're willing to, because they know, you know, the rate's got plenty of stability, 60 months, you know, 5 years. The rates, they're more happy to you know, give you a much more generous rental a maximum borrowing amount based off the rental received. So they just loosen up the ICR, and sometimes they may not even put it into play. And there are other instances as well. So there is a thing called top slicing. When top slicing is where certain lenders will use your personal income to top up the rental income as well. So we do have plenty of instances where the rental income can be insufficient to get a certain borrowing amount. However, there are some lenders out there that will consider your employed income, providing you meet certain criteria like income levels and things like that. Then that can also be used to top up the payments as well. And there are some really, you know, big players in the market that do that.
Oh, I did not know that. Okay. And so you talk about 2-year fix. What about on the 3-year, the middle ground? Would you still be doing the stress tests?
Yes, has the same principles as the 2 are 3. So the only one where we will stop is the 5. And you'll see it on calculators all over. You know, if you ever have a look, if you ever speak to a mortgage advisor, they'll tell you the same. If you are willing to commit to a 5-year fixed, I do tend to find in experience it's not very popular among investors. It's most of the time it's not enough flexibility, and it's you don't normally know if you want to have the property that long, let alone tie your mortgage in for that long. So we don't get them that common in experience, but yes, it is a viable option if you are looking to sort of boost the borrowing and the rental income isn't where you need it to be. Then definitely, speak to the bank or speak to the advisor about the possibility of doing a 5-year fixed, because there will be lenders out there that will lend 10 or 20,000, maybe even more in some certain scenarios.
Do you also get 10-year fixes?
You do, and predominantly on residential. There are some 15-year fixed now. Believe it or not, I think there are a couple of lenders that are looking at 15-year fixed deals. To be honest, there's a couple of 10-year ones, and the rates aren't too bad. I mean, you move into 15, and the rates they shoot up a little bit, but they are out there. Again, not very common. I've not personally done one this year, so it just shows that they're not what people are wanting to do right now. But they are. Again, if you want the mortgage for that long, I guess, and you've got no plans to sell the property, then and you can get that rate locked in, then by all means, yes, there are some. They are still roundabouts. They are still competitive. Okay,
so what are the interest rates now? Looking at the different lending products. So should we start with 2-year? Should we start with fixed, and then could you talk us through trackers and variables?
Of course. So I've got I'd have to bear. I haven't got any trackable variables. I've gone for the fixed.
That's fine.
I would say personally. It's all down to opinion, of course. I would say at the moment you want to be fixing your mortgage. I think personally, the rates I've pulled off, the ones I'll give examples of. I mean, it is hard, of course, because I've got access to so many lenders. It's we could be here for hours. But the fixed is the way to go at the moment. I think personally the rates are at an all-time low. I think that's where I want to be. So I've done 60% LTV and 75%. So the two different ends of the scale. Sort of 75% being quite common, 60%, obviously where you've got a lot of deposit or either a lot of equity in a remortgage. So I have done a couple of remortgages and purchases. So purchase 60% 2-year fixed. The most competitive rate I've got in terms of true cost of the 2-year fixed is a rate of 1.81% with no fees. So again, that's. You're looking at not even 1%, well, just over 1% above the base rate, and that's for a purchase. So that's very, very competitive. 75%, you can actually get a rate of 1.79. Comes with a 995 arrangement fee. So you can either add that to the mortgage or of course pay it on completion, and then you get £500 cash back to offset that fee a little bit as well. So, still very competitive for buy to let, with a 25% deposit. That's a very good rate.
Really good rate.
Yeah, of course. 5-year fixed, 60%, you're moving from 1.81 to 2.13. So, you're talking what, £20 maybe a month, not much at all in it between the 2 and the 5. So that's where if fixing for the 5 years will get you that rental, will get that borrowing that you need, you're not taking a massive jump in interest rate for that benefit. So if you are happy with a 5-year fixed, then again, you're not necessarily going to be paying so much more, and it's a lot more stability. Moving to 75% 5-year fixed, you're looking at 2.48%. So again, slight bit of jump, but this one comes with no arrangement fees. So that includes a free valuation and no product fee, that one. But still, for buy to let, very good. You tend to find they are higher than residential traditionally. Moving on to remortgages, 60% 2-year fixed. You're looking at 1.89%. That comes with no cost at all and a free legal service. So in terms of arrangement costs, there aren't any. So yeah, very, very competitive. Looking at the 75% 2-year fixed, 2.19%. So again, not much in it at all. The 5-year fixed at 75%, looking at 2.48, and then your 60% is 2.04.
Wow.
So I think what you can take from all that is they're all roundabouts the same, which is why I don't see how much further they can come down, to be honest.